Welcome everybody and welcome Niclas Sandström. We're going to have a great talk about a very interesting topic. How does one approach risk management in the world of cryptocurrencies? You run a couple of funds, you have a crypto company, you have a long history in hedge funds and also a PhD in physics, so you must be the best, at least in this room, with numbers. So how does one approach risk management?
All right. Thanks, Peter. It's sort of echoing what we talked about before when you talked about barriers to entry, or at least the items. So I would say there's different aspects. So first you have, with crypto, which is an immature, let's say, field, you have regulatory risk. And that goes back to the legal structure. So you need to have a flexible or some kind of right legal structure. Why is that a risk? Because the risk is, if you don't have the right legal structure, you might get no investors or fewer investors. You might have to tear it up and start, and that's expensive. So that's a downside risk. That's one thing. Then you have the risk with the technology, especially since it's cryptocurrency. So most of the assets are, it can be considered bearer assets. So if someone hacks into the system, it's gone. There's no recourse. You will almost always have recourse if a mistake is made in traditional finance, but in crypto, not so. Counterparty risk is something that exists everywhere, but maybe more so in crypto. So especially for service providers that will touch your assets, it could be either you sub-allocate to another asset manager. What happens if that asset manager defaults? Will you lose all of your assets? If you have assets with an exchange, the exchange defaults, what will happen? If you have a custodian, which is usually a way to safeguard your assets, but something could happen with a custodian and so on. So every service provider that touch your assets, you need to do a thorough due diligence. But even then, you can't be sure. So you need to keep up. Even if it was in a good state 1 year ago, you need to constantly be checking what's the status of your, let's say, important service providers.
And now you're actually mentioning risks that are outside of the market. Haven't touched the market yet.
Yes.
It's just by being alive in the industry, you're facing a lot of risks.
That's right. And, in terms of governance, before we get to the market risk itself, but governance, so one important thing is that you do what you say you do in the mandates in your fund prospectuses. And the reason for that is, you don't want to open yourself up to litigation. I mean, first of all, you want to run it the way you sort of set out, but you can, if you have poor governance, you can be litigated, and that has killed many a business, right? So that's why it's important to have good transparency, good governance, and a close dialogue with your investors. The market risk is actually the risk we care the least about. The investors might care about it, but especially maybe since we're algo trading most of our funds, let's say risk profile is set out, right? The market does what it does, and we just have to accept that this is the risk profile of this fund. So it's one of the risks that we're least concerned about. And crypto has a lot of market risk in it, but it's something you can control. The worst events are actually, counterparty risk or legal stuff that's really nasty. But if the market drops 50%, it does, right? That's it. But that's part of the game.
And the counterparties must be somewhat binary. It either works, or if in the case that it doesn't work, then it's very tragic. That it's
it can. You can get some recovery sometimes, but it still doesn't help. So I can give you a specific example. So in some cases, if there's a counterparty risk event, you lose everything. That's a disaster. But even in, let's say, take FTX as an example, the exchange collapsed in the beginning. The recovery claims were trading at 12 cents on the dollar. This was late 2022, right? But now a lot of assets have been recovering and so on, and the claims are now trading at 130 cents on the dollar. So people get 130% back dollar value that they had, not crypto value. I mean dollar value back then.
Yeah.
So for example, if you held Solana back then, maybe, I don't know, it was $15 per. So you will get the dollar value of that back, but you won't get the $240 that Solana is today. But that has taken, almost 3 years, or it's 2 years now. So it's a huge opportunity cost, and of course, a lot of people who got stuck in it, that was game over, because it doesn't matter. They get some recovery today, but the business back then. So it's I think counterparty risk is one of the most detrimental. If it materializes. It's.
But when you say that market risk is the least that you worry about, at least, is it because the risk profile is set and then you do as you promise to the investors? And
yes, we follow the mandate. It's algo traded, right? So we know if the market does this, we do this. It's all programmatic. So, and that's outlined in the prospectus. This is what we're gonna do, and then the market does what it does. But these are the risk parameters that we have.
But in terms of seeking alpha and trying to be a little bit better and squeeze out some more juice, how goes that into this whole relaxed risk? I would assume, at least for me as an investor, the first rule of thumb is to be great, is to not lose. That's the don't lose, right? So it's for me at least, it's a very high conviction that, or not like conviction, but I need some sort of focus on not losing, which is the risk. To be able to be there for the days when it's great.
Yes, but it depends on what kind of strategy you have. So let's say if you have a passive product, you're not long an index, you will lose on a lot of days. And in fact, if you look at a 5-10 year horizon, most hedge funds, they don't beat the index. So all the maneuvering and so on, if you buy and hold S&P, you'll do better. But you will lose on a lot of days. You will have drawdowns 30%, maybe more, and that's it. If you have like higher frequency trading, then if you go to the other extreme, you're a market maker or you're arbitrage. Most of the time you don't lose there, but typically you can't squeeze out that much. Like your returns are going to be less. It's hard to run an ARB fund or market making fund running $100 billion. But you have other type of funds which going to lose on a lot of days or have more risk in them, whatever we mean by risk. So it's always a trade-off. And what do the investors want? A lot of people in crypto, they can handle the swings because they want maybe a 50-100% return over some decent horizon. They are not interested in 10% per annum and not losing. Like they rather take losing a lot of days and at a shot at a bigger return. So it's all about the risk profile. And as we discussed yesterday, where are you in the cycle? When the market is beaten down, people tend to be much more capital preservation type of mode. They want low risk and so on. But in crypto, my personal view is that people have some allocation to crypto, then you should go for more high risk.
And what are the different risk profiles of the funds that you manage?
So the oldest one is in January 2019, but we ran it 2 years prior to that. That's always fully invested. So there's some alpha on top of an underlying portfolio. So we volatility trade that fund. We have 60 different cryptocurrencies, all long, always fully invested. So we don't de-risk. So when the market goes down, we go down with the market, and when it goes up...
So maximum you rebalance. That's the only...
It's the volatility trading where we rebalance and then earn some extra on the rebalancing. So that's high risk. It has had drawdowns of 70%, a couple of times or more. Then we have like a mid risk where we have some long bias, maybe let's say 30% long bias in the market, but we do go both long and short. So typically for that product, we're short like the large market cappers, and we're long mid and small cappers. And the reason for that is, again, we're volatility trading. We like to volatility trade highly volatile assets with low correlations. So those are the mid and small cappers that we select. And we like to short large cappers with high correlation. So typically Bitcoin and Ethereum, Solana and so on, they exhibit much higher correlation to the overall market. And those are the ones that we go short. And then we have the pure market neutral, low risk type of fund, 10-15% per annum target return. It's fully long short in that sense.
Very interesting, very interesting. And back to the risks then. So as an investor with your funds, there's a lot of regulatory stuff in terms of investing in crypto, and I assume there is some sort of benefit of going through a vendor like yourself instead of going directly. Or so, what's the benefits for an investor to go through Hilbert Group?
It's more So first of all, like the hedge fund world usually only targets so-called accredited investors. You need to be a certain size. Advantage, you hear about two structures in asset management typically, is like a fund structure or what is called managed accounts. So the fund structure, the investor invests with us. We take care of the assets and manage that. A lot of big institutional investors and smaller ones as well, they like that because then they don't need to care about the custody of assets, where should it be. They just invest. We do everything from that point on. And then if they want to redeem, they call a redemption and we return the capital. And that's nice because then some investors don't want to have that expertise. They don't want to pay for that in-house. So they just outsource all of that. There are other types of investors, some big ones that have that infrastructure, but they want, let's say, the expertise in terms of trading. So they then prefer what is called SMAs, so separately managed accounts. And what that means is that we are trading their account. It's not a fund, but they give us trade-only access to their account. The advantage of this is that they can monitor everything. They
keep the assets.
100% control of their own assets. They can switch us off, very easily. But it requires more infrastructure. It requires more knowledge to be able to run or be comfortable with having an SMA. So there are different types of investors, basically.
Very interesting, very interesting. So, and in terms of the what we meet in the crypto world, in the world of cryptocurrencies, with the exchanges and stuff.
Yeah.
How is that world looking today? We talked about FTX collapse and everything, but so I assume there has been some development of or seriousness.
Yeah.
In the world that started not many years ago, were only crypto bros and very not serious.
Yeah. It's been it's a big difference compared to the early days, right? And it's sort of converging to what it is in traditional finance. So if you on board as a private individual or private investor with a TradFi broker, there's a lot of filling out of forms, background check, AML, and so on. And that has come to crypto in full force, I would say, now. And it was, accelerated after FTX collapse. In the beginning, I can give you an example. So let's, after, this might have been 2020, maybe, something like that. You could have several accounts. You could just sign up to an exchange, like Binance in the early days, or whatever. And then you have a different email address, and you sign up. So you could have different accounts. The same person could have different accounts with the same exchange. That's not possible anymore. The amount of filing you have to do and regular updating of your data, it's more of a proper AML background check. It's much more cumbersome more work now. So that has tightened up. There's also pressure on the exchanges now that they need to have a good corporate governance structure. For example, Binance, by the way, we like. It's a well-run, it's a good exchange, but they have been forced to impose a lot of new measures, how they treat derivatives and so on. And this is all about, converging to, let's say, TradFi standards. But they didn't even have a CFO in the beginning. Or there was, and there's much more pressure from the corporate governance side now on all exchanges that you should have the right checks, controls in place. And obviously in FTX, it was chaos, more or less. The US part of it was well run, because it was in the US and there's much more. But the international part of it was, it was extremely badly run.
Yeah. But it's kind of interesting, because what you're mentioning then is that we see a shift from really tech-driven development to a more finance-driven development.
Yeah. Hopefully the tech is still there, but the tech is hampered, also by regulation. But that's right. And I hope, we think it's too much regulation, it's too cumbersome, and hopefully, blockchain can be part of all this AML stuff, for example, or KYC. If you have your own private ID on a blockchain, all that can be seamless in theory. And that's what we're working towards, or the field is working towards, one of the big use cases. That you don't need to fill out all of that, because different systems will talk with each other based on a blockchain. A bit like, Bank ID in Sweden, or which is connected to Swish and similar services in Norway. The fact that you just then, everything is verified. The system knows I am who I'm claiming to be, and there's no need for me to sit for hours and fill out forms. So it can be, and I think we're getting there, but there's a lot to be done still on it.
Thank you so much.
Thank you.